Good day, everybody. Well, we've got the beginnings of a potential market correction underway. Right now, the averages are really only off just a hair, and there was a lot of new highs being set over the last few weeks. A lot of leaders have been doing very well and pretty much getting ahead of themselves. And so after July 4th, when the markets hit new highs all around, the markets found an excuse to sell off. And as we know from last year and a half, when the markets drop 1 or 2% in a couple days, the leaders get taken to the shed and shot. So this time's a repeat of that. Leaders definitely took it hard. A bit reminiscent perhaps of earlier this year where the averages came off. By the time they came off 2 or 3%, the leaders were being drubbed, pummeled. So right now, hopefully, you know, some of you I know are taking profits in this market environment ahead of or we're just at the first sign of market weakness, which is a reliable strategy in this environment. And some of you others are using more of the 7-week rule. There's nothing wrong with that. The 7-week rule means that you have to have the stomach to withstand a stock that's going to potentially drop all the way back to its 50-day, gain traction, and then move higher. And as you can see, some of these stocks have done well using the 7-week rule, with more volatility naturally, because you're going to have to withstand corrections back to the 50-day. But then you won't be left out when the stock resumes its uptrend. I'm a bit split in terms of how I handle stocks. I sometimes like to get out at the first sign of weakness, even before violation of the 10-day moving average. And then my other trading personality likes to hold on to core positions sometimes out to in some cases, months. If I do believe that the vehicle is going to be able to resume its uptrend. And those are the types of vehicles where I believe that I can do 50 to 100% gains, at least 50 to 100% gains in a matter of sitting with the position for months. And I will trade around the core because I don't want my whole position whipping around like it does. But to my mindset, I don't mind a core position that might be a very volatile position. But that works for my trading style, and everyone, as we always say, has to find their own trading fingerprint, what works for them. But at any rate, it looks like this correction due to Portugal and reinterpretation of the Fed minutes is probably going to be a short-lived one, like we've seen in the past. Markets can entirely drop further from where they're at. Like I said, the markets right now are only off 1 to 2% off their peak, so wouldn't be surprised to see a standard correction take place where the majors correct a few more percent. But on the other hand, that might be the low, and maybe markets resume their uptrend. The Fed has stated that they're going to continue to keep rates unusually low, and the market expects these rates to be kept at these levels until well into 2015. So even though the Fed's going to end, they say they're going to end QE, bond buying, by October of this year, the fact that they're going to keep rates unusually low into 2015 implies they've got another set of tricks up their sleeve. Very well, I follow Bill Gross's words whenever he does speak, because his track record speaks for itself, and he tends to have a very macro view on situations concerning bonds. So when he says that these bonds are going to be low, the bonds are going to be low well into 2016, and it's assumed as long as the reports led on. And I think the Fed knows that, and so they're leaving themselves an escape route when QE in the current form ends in October of this year. They've got an escape route to keep interest rates unusually low. Gil?
Yeah, okay. I'll go with all that. So what do we got going on here? Pretty simple. You're pulling back to the top of this area here. See the 20-day exponential moving average. Both of the indexes coming down right there and getting some support yesterday. For those of you in the chat room, I use my rule for selling stocks, and if I buy them right, like say Palo Alto Networks, buy it here big and it runs up, and then and it's going higher, gap up here. And my rule is if they look at me funny, I sell them. And so, this thing, it gaps up and then it fails immediately. And I was, at that point, I'm pretty much out of this thing. It looked at me funny, have an outside reversal day more or less, and not quite, but for me that's close enough. With a stock like Palo Alto Networks, it's close enough for handguns, hand grenades. How does that one go? Hydrogen bombs and something else. So horseshoes, hand grenades, and hydrogen bombs, I think it is. But in any case, that runs, right there. It's running into trouble. IBD has a big article talking about how Palo Alto Networks has arrived, and of course you're getting a breakout from a cup with a handle pattern here, but the best buy point was this sort of weird double bottom breakout on the Bible gap up. And I think the market's just following the same pattern. We talked about this, I think, the last couple of webinars. Pretty simple concept, which is that the indexes seem to get like 5-6% past the 50-day moving average, and then they start to correct. And the first clue that you're running into some trouble is that leading stocks start to run into some trouble. So you see Palo Alto Networks doing that. We already saw names like Cavium going nowhere. You've seen Green Mountain going nowhere. Illumina, you had to buy this thing here. And this is the same pattern with most of the market recoveries, that the best money is made by buying these roundabout sort of pocket pivot moves, even some bottom fishing pocket pivots, because I made pretty decent money trading Twitter on the basis of bottom fishing pocket pivots down here. Some other stocks, Yelp, worked pretty well, but notice, it could not hold the 10-day. Now, I would say when you got stocks moving with that kind of velocity, and let's say you bought on the basis of this pocket pivot here and you hung in there, you would have made nice money on that trade. But you see here, you fail on the move to higher highs and reverse, and then it falls through the 10-day moving average here. If I'm long a stock like this, I'll just sell it right there. So usually when I have something working very well, the 10-day moving average becomes the point at which, the point of no return. If the stock goes below, it's gone. And that's just the way I handle it. And in this market, that's the way it is. The other thing is I'll take 10 to 20% profits or more when I have them. And so that naturally forces me out of my positions taking profits, and nice profits, to get 10, 20%. Like GWPH was over about a 30% move from here up to 113. That's a very nice move. And you take that. And then here comes the stock. I talked about this one last week. I thought you have 1, 2, 3 gap ups in the pattern, but this time, it's getting a little long in the tooth. Everybody sees it. It's not nothing that is tricky. It's probably trickier as a buy in here because most people are thinking it's either extended or it's too soon. It's still in the base, blah, blah, blah. And if you're using silly IBD rules, you're buying breakouts and getting your head handed to you time after time. In this market, and so the pattern's the same. You buy the pocket pivots coming up around. There's a number of examples. SunPower in the base, you had the Bible gap up. You also had some pocket pivots, I think, in here, and then the breakout. Okay, great. You buy the breakout, it runs up, comes all the way back. And for me, I bought it down. You guys know this. Go back about a month or so. I'm buying the stock down in here. I thought it was buyable in here as the market was turning. And that was a big position for me. It gets over 40, I sell it. I take a nice 30% profit and I sell it. And of course, it breaks down. And that's what they do in this market. Now, if it comes all the way back to the base here yesterday, I'm more than willing to come in and buy something. Yesterday morning, I thought, as I tweeted, and I was on the chat room saying that you're probably at an exhaustion low because you've come down for a few days on a lot of these stocks, So this thing down by yesterday is down 1, 2, 3, 4, 5, 6 here. That's actually your low, and then it's trying to bounce. So by yesterday morning, you're gapping down on news out of Portugal, which I think is just starting up the whole thing with the reality that banks across the globe are insolvent, and liquidity, massive liquidity, I don't care how massive it is not a solution to insolvency, and ultimately something's going to have to pay the price. As Dr. K has said many times, at some point something's going to have to be paid up on. Some bill is going to have to be paid, and the consequences realized. So when that comes, who knows? I think what the Fed's trying to do is play the Japan game, where you keep rates pretty much at zero forever and just kind of limp along and hope that nothing terrible happens. And I guess they're stuck, and we've said this many times, that they're stuck. They have no clue what they're doing. So if you think that they have some idea about how they're going to manage monetary policy and create a wonderful soft landing when they do start to find a need to tighten, I don't think it's going to happen. So anyways, but so just getting back to the basics here, same story, different month or different quarter. Leading stocks have roundabout pocket pivots. You buy them there as the market's turning. You get your best price moves from those buy points. Once they start breaking out, look out. And the market gets 5-6% past the 50-day moving average on the NASDAQ and or the S&P, and you're ready for a pullback. And they can be pretty hairy pullbacks, because if you've owned stocks for the last few days, you've watched a lot of your gains disappear. Look at this one. I love this example because it went up, what's the rule, the 8-week hold rule, Dr. K? If it goes up 20% or more in 2 to 3 weeks, you got to hold it for 8 weeks.
That's Bill O'Neill's rule. It's not something I've ever found useful.
And you know what? It's a stupid rule, okay? It's just a stupid, ill-considered rule. It's typical Bill. He's going to use 2 or 3 examples. He probably had a stock once, and it went up 20% in 2 weeks, and he sold it, and then it turned around and went higher. In this market, it just doesn't work that way. You've got to base your buying and selling on more concrete methods rather than these sort of mindless rules that don't really apply to what's happening in real time. I think the market's changed a lot in the age of QE, and I think basing your strategies on history, market history, that is irrelevant today in such a distorted market is not going to yield very good results. And you have to keep moving in this market, and you have to understand the rhythm of this market. Anyways, I try to go in the chat room and give people some sense of that. But the bottom line is, yesterday morning, you had already come down on a number of stocks, and to me it looked like a big washout. And if I'm short anything on a morning like yesterday, I'll cover, and sometimes I'll turn around and go long. I was short CRM, and it came down yesterday, went through the 50-day, and you could feel it sort of lift up. So I just covered the short, turn around, go long, and it actually moved up a buck for me. So a little scalper trade, but I'll do that, and I'll be very quick. And a lot of when I operate on the short side, a lot of what I'm doing is day trading. Maybe I'll hold stocks overnight, but for the most part, what I do is I look for continuity in the price action on the way down. So let's say, for example, I'll show you some stocks I went short on Monday, and I talked about this in the chat room, that I'm watching these bottom fishing pocket pivots like Yelp. Okay, and they're coming up, and they're looking pretty good. Netflix was able to come out here and run higher, and that was really your best buy point. If you're buying the breakout here, you get whacked. But you look at, say, Yelp. I had been long this stock, and as soon as it broke, anything I had, actually I think I tried buying some off the 10-day, and it didn't hold. I sold it immediately and went short. Boom, they slammed the stock. Data, here's another one. You see the left shoulder, the big head, and you come right up into the 40-week line. That's where you reverse. So I'm watching this, and as I see this thing come down on Monday, right in here, it's under the 10-day, and it's violent. I just short it. So I shorted that one. Workday. Shorted this one. Same thing. You can kind of see it running out of gas up here. It's looking pretty good. You're getting some pocket pivot action in here. Pretty good upside volume, but they can look good just before they roll over. So on these right shoulder rallies, and that's sort of the paradox, and something that you really can't tell for sure, because you never know if you have something that's more like a workday that's going to rally for a little bit and then just form a right shoulder and then die. And you never know whether you have that or you have one of these. I think in this case you have a better sense. So when Netflix turned, we had a better sense that at that point the NASDAQ was bouncing off the 200-day moving average after coming down for a period of time and getting pretty obvious on the downside. So you can kind of put it together, and this thing's turning. The market looks like it's turning, and you get the pocket pivot in mid-May when the NASDAQ comes up through the 50-day, which is a point at which I thought you had a good chance of resuming the rally, and basing that on the action of a lot of other stocks that were showing bottom fishing pocket pivots and roundabout type pocket pivots at the time. So, once you've got this going on, now you're getting long in the tooth. This may become a pod. And workday, same situation, but I just see this sort of die, and on Monday as it's coming through the 10-day moving average, I hit them right there. And I'll use a 10-day as my upside stop very quick on the upside, and these things all blew apart. I mean, Tuesday was a beautiful day because you saw a lot of these stocks, workday data, Yelp. I did short Palo Alto Networks on the 10-day break as well, and it drops right down on Tuesday, right to the 65-day and back to the Bible gap up. And these things were down 3, 4, 5, 6, 7 points. Buy 5,000 or short 5,000 shares each, and you're making some lunch money. Anyways, and look what's happening overall. Twitter has been acting well, but it got whacked, and it's down to the 50-day. That's a logical spot to bounce, and bounces with the market. Facebook gets whacked. I mean, look at this thing. On one day, though, nobody wants it. The next day, they come back and push it right back up, and it's pushing back to this breakout point on this cup with handle. It might be a short point there, but Facebook is a big stock, and I think institutions own a lot of it, and they'll defend it when it comes down. I don't think they do that necessarily with some of these other names that look a lot weaker. Anyways, let's see. Where am I? SunPower, got whacked, but I don't know. I'm not looking to buy it here. If you bought it, yesterday or on Tuesday when these things all washed out and came back to the top of the base, that's maybe a spot where you can re-enter. But who knows whether it's just a short-term trade and we roll back to the 50-day. I wouldn't be surprised if a lot of these things bouncing off of their 50-day, or say in the case of Palo Alto Networks, which is bouncing off its 65-day exponential. I wouldn't be surprised if these things rolled over and either retested the lines or even possibly broke through them. But you're not seeing any real buying interest in here in terms of volume on a lot of these names. So, another one that I was campaigning on the short side the other day was, and I went short this on Monday, right at the 200-day. I mean, we've talked about this one before. It's a zigzagging stock, shorter when it reaches a peak here, and boom, it comes right in over 2 days. And, of course, on Tuesday you come in, and I felt you could take profits there. But what I'll do is I'll come in. Let's say I shorted Yahoo here, and I get a nice break here. I cover it by the close, and then I come back in the next day here or around in here, and it breaks again. So I'll play them continuously that way. In my view, that exposes you to less headline risk. If something gets bought out, like let's say if you'd been short, you certainly would not want to be short open table overnight here because you'd have been killed. And I think in this market, that's always a possibility. And the short side, in my experience, has that risk more so than on the downside, I think. But you can play it however you want to. If you're going to hold shorts overnight, then I would say you're probably holding smaller positions than I like to play, because I like to come in 50 to 100% short on something if I have conviction. So what else? You see the oils getting smacked. Fang. I liked Fang. I like this name, holding in tight, and now you're coming down to the 50-day. I did buy it yesterday off the lows and traded it for a couple of bucks, but that's it. And let's see, the other ones, EOG is one we've talked about. Some of them are holding in okay. Athlon is holding in okay. CLR, Continental Resource, they're holding up. But for all you know, it just means they're ready to come down, and they'll come down with the market. So gold the other day had a pocket pivot on Wednesday. I'm skeptical in terms of buying gold. Yeah, I think it's going higher one way or another. But if the market gets into some trouble, and let's say the issues in Europe, which I think Tuesday was giving you some indication of something was up, and somebody was, the way they were selling stocks off just relentlessly and almost indiscriminately, and knocking some of these things down 10%, over a couple 3 days. To me, that spoke of forced selling. So someone's got to raise cash on their balance sheets, and they're selling securities to do it. And my fear is if you get into a situation like that, you can go back and look at the final break in 2008, September of 2008, for example, and other periods where the market has broken down. generally all asset classes will follow, such as the GLD or precious metals. So silver, no pocket pivot there, but so I'm not sure. If you like this, I guess it's playable. Dr. K, you have any view on the precious metals that you would like to convey? Are you roaringly
like
bullish, or?
I've said what I've said before still stands. That is, these are in basing patterns. I'm not interested in these in gold or silver until their base completes, and because they do complete, and then it's a very easy buy. It's a very obvious buy signal to my chart eye, and gold has a rhythm of doing this since 2001. So I don't want to mess around with it in the meantime. I'm not looking for small gains. I want to get in when everything's all lined up. But that said, my style isn't everyone's style. So if someone wants to try to play this for fundamental reasons and think that it's near the bottom of its base, there's nothing that wrong with doing that. I mean, if you could risk some money, but it's probably, you don't know how long gold's going to be moving sideways like this. I wouldn't want to have valuable capital tied up in something that I don't know is going to go a whole lot higher in the near future. But if you've got some money and you just want to just let it sit in gold, put 5 or 10% of your portfolio in, because you do believe the base will complete and it will go to new highs at some point because of all the QE in the system, yeah, there's nothing wrong with that. You don't have to have every single dollar or pound of your investment capital sitting in high-octane stocks. So I do believe fundamentally, yeah, it's probably going to complete at some point, maybe next year, and we'll see it off to the races again. QE is, across all these central banks, it's unprecedented, and the saying "don't fight the Fed" is "don't fight the Feds," and that the market since 2009 has proven that one should not fight the uptrend. I can only imagine people who are, sitting in their short positions for, more than a few days, getting caned in this kind of environment. It's kind of reminiscent of the late 90s when, everyone thought the market had topped in 1997, that was it, that first quarter of 97, that was the major market top. And then Greenspan coming out with his famous irrational exuberant speech. But of course, markets did not absolutely top till March of 2000. And meanwhile, 98 to March of 2000 were the most profitable period. It was the most profitable period I've ever observed in the markets, and having studied the market going back over 100 years. Those 3 years, that segment right there was amazing. So, and we could get another one of those blow-off periods where there's just too much money in the system and inflation starts to get out of control and hard assets start to rise. So that bodes well for gold, silver, and stocks.
Yeah, I think the basic move towards monetizing debt and devaluing currencies is positive for precious metals in the long term. So, but Dutch, I wouldn't argue that since 2009 this has just been a bull market. There have been some hairy corrections in this market that have been extremely profitable on the short side. Most notably,
sure.
the one that started in early May of 2010. There was also, was that August of 2010 as well, was pretty brutal. Because I remember the model had a signal.
Last half of 2011 was great.
Yeah, and the model had a signal that
lots of profitability there on both sides, both the short and the long side.
Right, and didn't the model have like a 41% profit in just a couple 3 weeks? So.
Yeah, it was great. It was a nice time, and the people were worn out by the markets by middle of 2011, understandably, because it was very choppy sideways, as you could see on the Nasdaq and the S&P, and leaders weren't doing what they should. So profits were almost non-existent that first half of 2011, and that's a great lesson for investors who throw in the towel, only then to see everything get back into sync. And I remember those kinds of investors were by October and November, they're coming back into the market trying to make money at it. But then the sweet spot was over. The sweet spots often are only good for a few months at most, especially in this kind of environment. So you kind of have to stick with the program and
there it is.
Not get too tangled up in in the small losses, hopefully the small losses that might accrue over a period of time.
Here's August of 2011. Look at that break in the Nasdaq. See, my theory is right now we're right here. We're coming down. We're going to have one more little bounce, and then we're going to break like that, and it'll occur in August. See that? See the precedent there? See, it's a roadmap. You can use it to invest without having to think. Anyways.
But yeah, it looks. I mean, what's nice is, I mean, if you look at the weekly on the Nasdaq, it's a pretty fierce bull market since 2009 with pockets of corrections and things. So, you know, that pattern, this overall secular pattern, is probably not going to go away until interest rates really start to head higher. So, you know, because it's just too much money and flooding the system, and there's no signs of it really slowing on a fundamental basis, and possibly out, you know, again out to 2016. I wouldn't be surprised. And then, of course, as we move close to 2016, I'm sure these projections will get revised, and you know, a guy like Bill Gross might be moving his projection up to 2017. Who knows? Can't predict these things.
Let's see, some questions here. Somebody, do you enter your trades with stocks or with options? I just use stocks, so I don't really understand why that's a meaningful question either. I think if you understand options, you can use options. I just use stocks. And whether I use stocks or options, I don't see how that's relevant to anybody else's trading, or whether Dr. K does. Yes, I use options, and so should you.
Sounds
like the who are those the brothers on CNBC advertising their options book. Somebody says, could GWPH be setting up for an H&S? Whoops, this is not. Let's go to the correct chart here. I don't think so. There's no high volume break off the peak that would cause you to think there is a head here. So, I mean, who knows? You know, if it broke down here and you had a huge break that took you down in here, where this could be a left shoulder and this turns out to be, who knows? You know, I don't know. The one thing that bothers me about this pattern is it has had a long run. This is kind of a deep base. The high here is 86.45. You drop all the way to a low of 41.80. It says 50% deep, and it's a little bit obvious. It might be. So the only thing I'm cautious about is whether this is a late stage base and it has some potential to fail. So I'm not. I don't believe that you can necessarily just, oh, this is a great stock, it's going to the moon. I don't think you can assume that. You just have to handle it in real time. In this market, the pattern that leading stocks follow too, in terms of running up and they're getting cratered and then running back up again, just increases the risk of trying to sit. It's very tough. So anyways, everybody wants to short today. AL, possible short, I don't know, Barry trades 1 million shares. Why would you short it here? I don't really see why. It already had a move down. You had to short it. If you're going to short it, let's say if you considered this, and this could easily be, you know, late stage failed base situation. The only problem with this is it only trades a hair over 1 million shares, which for me is too thin. If you're going to trade 1,000 shares or 2,000 shares, I guess it's okay, and you can move with it. But I watch this one on the long side. It's very thin. But see the breakdown here? That's a base failure right there. So you get the rally back above the 50-day moving average, and you have to be shorting it as it's starting to flake out here. You know, you're seeing some heavier selling here. You could have used that as a reason to pop it right at the 50-day moving average here, and now it comes down. But yeah, shorting here, that's kind of pathetic. You know, it's like you have to anticipate these things. And the fact is, everybody reacts suddenly. You know, yesterday they want to get short. Everybody wants to get short. You know, on Monday, I'm on the chat room, and I'm telling everybody I'm blown out of my lungs going short, and short on Tuesday. You know, people like to rely on bromides like it's only one day. It's like, yeah, sure, when your stocks are down 7 points across the board, it's only one day. Certainly not a day I'd want to be sitting through. But in any case, you know, that's your first break. You undercut this low. The only way you're going to short this one is on some sort of rally up into here. But for me, it's too thin. Somebody's asking me, stalling on the upside move is something that you look at for a change. In your experience, is there anything like stalling on the downside that could be indicative that is a prelude to some sort of a turn? Stalling on the downside, well, that's supporting action. So, you know, what's in a label? Stalling on the downside. That would be what I would call supporting action. So in other words, if you see this, here's, I guess this would what you call, you made up some new terminology here. Stalling on the downside. We'll no longer call it supporting action. We'll call it stalling on the downside. Yeah, it's getting some support off the intraday lows. So, you know, maybe it does, maybe it doesn't. But it doesn't, in and of itself, it doesn't tell you anything, okay? So there's no one signal that tells you there's a low or a high. You see it in confluence with other things. And you could see, you know, on Monday you could see some of these stocks starting to flake out. You know, I've been following stocks like Yelp, Twitter, Palo Alto Networks, and others very closely, and made some money on the upside. And I can see when they're starting to wobble. And they began wobbling last week, but you couldn't really tell what the action was all about because it was a short holiday week and trading volume was relatively light. But you know, if you go back in hindsight, look what happened. This was your this was actually the day before the long weekend, right? And it was really light volume. And guess what? It stalled at the peak. It ran out of gas and stalled right at the peak on light volume, even though it was just due to the holiday. So, you know, a lot of times you take the action on its face, I guess. But in this case, that's what turned out to be the case. You get boom, boom, two distribution days you're coming in. But you could start to see stocks wobbling, you know. And you're seeing some stocks were getting hit before that. So I think you put that together, the indexes are 5-6% past the 50-day moving average. Everybody's bullish. Nobody wants to be short, you know. Anyways, now everybody wants to be short. Could Dr. K please briefly repeat the comments at the beginning about Bill Gross and bonds? The London internet connection was wonky.
Yeah, sure. Bill Gross, manager of the largest bond fund in the world with an exceptionally excellent long-term track record, has a great macro view on things that has proven out time and time again. And his view right now is that the economy is not going to be recovering as expected, so the Fed's going to be forced to keeping rates unusually low for longer than they're thinking. I mean, right now the market expects rates to be kept unusually low until sometime in 2015. Bill Gross thinks it's going to be more like 2016. But as we get closer to 2016, I wouldn't be surprised if a guy like Bill Gross sees that the recovery is really not taking hold as it should, and so he revises his view to 2017. And that's pretty much it.
Awesome, and you were clear the whole way through. So hopefully they heard that. And let's see, Amazon. Somebody asked, would you short Amazon on a rally up to the 200-day? I think the more important question is, would you? Who cares what I would do? Maybe I would, maybe I wouldn't. It's moving up on higher volume on a day when the tape is down. NASDAQ's up, though, but that's probably what's helping it to be up. You got Google, Baidu, Apple all up, so they're all helping the NASDAQ today. I don't know. It depends on what it's doing. Right now I wouldn't, because you're kind of getting a pocket pivot off the 10-day moving average. So if you can see that, if you exceed this volume level, which looks to me like you're going to do by the close, since it's only 8:30 my time, we still got another, what do we got, Dr. K? 5.5 hours? No, 4.
4.5.
4.5 hours. So, I don't know. But again, everybody wants to get short all of a sudden. Short this, short that. Sell your wife, your kids, your cars, your collectibles, and whatever else you have that's fungible, and or is that fungible? Anyways, and put it all in a short position in Amazon. Yeah, sure. Let's see. Any more questions? Long GPRE. So good. That's good. You're long. I'm glad you're long, and it's going up. But you know, what can we tell you from here? You sort of had a pocket pivot. It looks like on Wednesday. coming from, you're slightly extended from the 10-day, but it looks close enough to me. So it looks fine. No reason. Green Plains, is this a oil company or is this a food company? Energy alternative / other. Got some decent forward numbers. So ethanol and corn oil, that's what they do. So yeah, it's holding up. One of the few things holding up. Whether you have to sell it here, I have no idea. If I bought it down here and I had a 20% profit in it or whatever, I probably would myself. Let's see, CMG. Here's another one that turned with the market at a pocket pivot down here, and now it's forming this sort of cup with handle. I think earnings come out in the next few days, and so I don't think I want to be shorting anything into earnings because I think it's basically spinning the roulette wheel. I would watch these big cups, Netflix being the other one, as potential. Well, I thought Netflix was a short on Tuesday going through the 10-day line, and the only problem is I couldn't borrow it. So if somebody else was able to, that thing's come down a fair bit, and it is starting to look like the proverbial punch bowl of death formation or pod, because it's about 30-something% deep base. So it's not, the end of the world there in terms of being a 50 or 60% deep punch bowl type pattern, but that looks like it could be setting up as a punch bowl of death. But they come out with earnings next week, I think. So anyways, let's see, CMG, that's probably going to be when the stock breaks down. So CMG, same thing, it's weak here, they get whacked. I think somebody upgraded it yesterday, or not yesterday, but Wednesday, and it pops back up. Is that a pocket pivot, Dr. K? Would you buy that straight down and then straight back up?
Well,
No.
the thing about these retail stocks is going to be a little bit more volatility in the pattern, but I don't like what it did earlier in the base. I mean, that was really wildly negative action in the base. So I don't know if I like the stock as much as I used to. And if you look at the run leading up to the current base, it's a bit sloppy as well. So this is not a particular favorite stock of mine. You also got earnings that look like they're slowing, so and into the next quarter as well. So more reason to look elsewhere.
Yeah, and it's not real Mexican food, anyways. So
No, it's full of calories too. They make people believe that it's healthy. I guess it's healthy on one level, but if you're trying to lose weight, it's a really bad idea because the burritos have a whopping
6 million calories each.
1,400 calories a burrito. That's assuming you're going to put the normal toppings that most people put on the burrito. But if you take the base burrito, what they do is they say, oh, this only has 400 calories. But no one eats a base burrito. Everyone's got like the salsa and all the things on it. So it's a bit misleading.
Let's see, any more questions here? We're about 40 minutes into the webinar right now. I'll just start babbling here, but you're seeing so many stocks just getting whacked. I was looking at here's Kate, that's trying to bounce it, but they're going nowhere fast. And if you're somewhat observant, or if you've owned some of the stocks that we put pocket pivot reports out on early in, say, late May or even mid-June, when the market was just starting to turn, you have profits, and you can take some of those. If you bought things later, they tend not to work. The GTAT was breaking out, looked great. You can see it stalling, but again, here's a pocket pivot. You're probably better off buying this, I think, than you were buying this. And in hindsight, I probably could have. You could see that pretty easily. But if you were in the chat room, I thought this thing was buyable coming in here that day and had a nice 10% move up. And if I get something like that real quick, I'll tend to sell into it. I had a core position on Monday, which is pretty small, and it was gapping down to 18 right at the opening, and just sell it there. And that's this is Dr. K's rule of when you have a huge volume gap down off the peak like that, you just got to get out of the way instead of sitting there hoping.
Yeah,
and
just sell it.
Yeah, and I had some, and I dumped it. And I was actually, I think, up on that day after all was said and done because I flipped and went short a lot of stuff. Uh, and then I'm not nursing it here. You know, some people trying to hold it down here. I think that's silly. And then, of course, you get the guys on Seeking Alpha telling everyone why it's a great buy now down here. I don't think it is. I think there's something wrong here, and you don't want to be anywhere near this right now. That's my view. Maybe it's another NQ. Whoa, look at that. That thing just got crushed. But see, again, I guess this move made it cautionary. We talked about that, even though there were some buy points in here. But once it started to fail up in here, you're gone, hopefully, unless you're one of those goofballs that sits with stocks forever. And they're out there. I think they have a wedding ceremony every time they buy a stock. Anyways, let's see. Please explain a MACD stretch. Very simple. Here you see, I'm going to use Yelp. Yesterday morning, stock's getting hammered right off the bat. I think. What do we at? Right here, right off the bat. You come down the MACD. See these MACD histogram down here? They stretch to the downside. For me, that's a cover point when I see something drop like that, or if something's rallying. That can also be a short sale point. So let's see if I see any others. Here's another one. Here's a MACD. You see the MACD stretches, and then it stretches back to the other side. You could have shorted here, but probably would have stopped you out. I think I was watching Facebook yesterday. You got a MACD stretch here this morning, right up in here on Facebook. Yesterday you had not really much anything. Let's see. Here's another stretch. Well, that's after hours. Forget it. Here's another one where it stretches, and that's a low. So when I start to see that, if I'm short something, and I use this contextually. I always dread revealing some of these things that I use because then everybody wants to, they want to know what the rules are for using the chart. There are no rules. You just kind of use it as a guide, and you get to know the 620 chart with 6-period and 20-period exponential moving averages, and the MACD I think is set up the same way. 620-10C. Somebody asked me what C stands for. I think it stands for cheesy. I don't know for sure, but if it isn't, maybe it means close. I don't know, but does it matter? Not to me, really. But here you can see Facebook now in real time. You're sort of getting a cross here. Well, you have a cross here. You have the MACD stretch. So, maybe ready to roll over. I don't know. I've got some other shorts out today. Pandora. Just kind of bopping around here, so I got shorted in here as it's coming up into the line here and then coming off. Yahoo just had a rally that I thought was shortable on this. You see the MACD stretch right there, so you short into that, and it's coming in a little bit. It's nothing really to write home about. Delta Airlines, similar sort of thing in here on this kind of break, but no MACD stretch. But see how the MACD is kind of weak, so it's kind of telling me these rallies aren't all that strong. So I'll hit it up in here. Not a huge position, I'm just kind of testing the waters here. Yesterday I was in the chat room. I thought, Facebook could have been, you could test it as a short thing. It'll stop here, but I would have used, I think I put, I'll go short something. I might give it 20, 30, 40 cents. I don't give it much room, and I'll cover it. And that's how I, put my stops in. I decide, what's the maximum I'm willing to lose on the trade, It has nothing to do with some masterful calculation, or some checklist of rules that I follow. It's just I decide, okay, I'm willing to test this thing here at resistance. How much am I willing to lose? That's it. That's pretty much how I set my stops, using the idea that if it gets past the 20-day, it's probably going to the 10-day. Now if it gets past the 10-day, it's probably going higher. I don't know. We'll see. But that's how I do it. And I can't stress, Dr. K, I think you agree, that one of the things that really helps you more than anything is experience and studying your own trading and spending the time required to understand what's happening in the market. If you think you're going to do a part-time, or someone's going to hand you some magic formula made up of 7 magical letters that you're going to follow these magical letters and they're going to make you piles of money, I think you're just stupid. And foolish and naive.
No get rich quick ever.
No,
If that were the case, then everyone would actually be doing it. And the thing about get rich quick is there are times when you can get rich quick, but that's when most everyone thinks it's not possible. So you're only going to get a few, this would be like internet in the early 90s. There's lots of get rich quickers then, but most people didn't believe it.
Yeah.
So in other words, it comes back to the whole thing. Making money is not an easy road psychologically or on a practical basis. You have to have some insight, or you're thinking outside the box. You're not doing what the crowd's doing. The crowd will never all at once make huge money. It's just not possible.
Right.
So from a psychological standpoint, it's kind of interesting to see how the dynamics of people who want to get rich quick, but often those are the ones who don't have the insight to see when those very rare situations do arise.
Right. It's not as easy as you might want it to be. Anyways, let's go through some more questions. We're trying to get some. See, I figured if I started babbling, everybody wants me to shut up, so they'll send in some questions. Solar City. Here's a situation where it could be a left shoulder, or maybe this is the left shoulder. Here's the head. Now you're making a big, ugly right shoulder. My guess is probably is, but would I short it using the 10-day moving average as a stop? Would I? I can't borrow this thing. It's a swirly stock, has huge short interest. You could and use that plus another whatever you want to lose as your upside stop. So yeah, I mean you could, because it's looking. You're seeing a lot of these patterns. That's my point. And the point I was making on the chat room is that I'm observing this. So you have to watch how these things play out. I remember we got an email from somebody who read about that, what I was talking about on Monday, that a number of stocks were potential RSRs. We've been talking about that for a while, but they want us to put out an email over something I chatted. My view is if you can't make it into the chat room, too bad. I'm not taking content where it's really just an informal discussion, and we're making real-time observations, not all of which are going to be correct or profitable observations, and we're supposed to somehow decide which of these are major calls, and therefore we have to put them out in an email. I'm just not going there. The chat room is intended primarily for members to kind of mix it up together, because there are a lot of great traders out there that are members of VOSI, and so we think that's useful. But I go in there and throw in my 2 cents, but it's definitely not intended as some sort of major calls. I see things happen in real time, and I'll react to them. If I'm wrong, I'll flip out and the other way, and just bail out. And so to give somebody a running commentary all the time and sending out emails based on some sort of observation I might be making in real time is not really practical, nor is it all that useful. But it was something that you could watch on Monday, and to me it's a clue, because it tells you that the market is in a position where logically some of these stocks that have rallied up off their lows, like the Yelps of the world, like the Datas, and like the Workdays, and like the Splunk's another one. This one's really the ugliest of them all. They're looking like right shoulder rallies, and we can also surmise that the Nasdaq got some punch from some of these names because they got on these rallies, from Twitter to Splunk to Workday and all those in between. The Nasdaq was helped along, so I think it helps manipulate the indexes higher, and that's how we go to new highs. Now, if that's my theory, then it'll be proven out or borne out by the fact that you'll see these things roll over, and that's exactly what happened on Monday. And so I'm willing, if I see that, and I can derive some sort of, say, thesis, I can test that thesis by placing a short trade. And as it turned out, all the short trades were beautiful on Monday and Tuesday, because everything just got hammered. And I'll test it out. There's nothing that's gospel-like about it. You see something, you make an observation, and you develop a thesis, and what would confirm the thesis, what would disconfirm it, and then you decide how much you're going to lose on the trade, and you go from there. It's pretty simple. UA, this is another one maybe doing the same thing. This looks a lot like CMG, doesn't it? Yeah, very similar. So I don't see anything here. JD is a piece of garbage. It's just flopping around. It needs to settle down. Zip, zip on the weekly. Same thing on the daily. There's nothing going on here. So I don't even. Yesterday you said that FB may tell us about market direction. Is its action today indicative in any way about near-term market direction? Well, you've seen Facebook bounce, and the market is trying to hang out here along the 20-day exponential. So, my thinking is if it starts to break, and you'll see other stocks as well, but all by itself, it's not the one and only barometer. I guess it could rally while the market breaks down, but I think that, you see Facebook come down to a low, the market kind of finds a low. And it's bouncing. It's a big stock. You look at stocks like Apple, for example. It's a big stock. It never really came down. Amazon, same thing. It found a low yesterday, and it's bopping back to higher highs. So that actually looks pretty good. So maybe you could buy it and sell it at the 200-day. I don't know. Rates. What ultimately controls them? World market demand? No, the central banks do. Couldn't be the clueless Fed. Well, they do. So, Dr. K, you want to expound on that?
Say that again. On
what ultimately controls rates, interest rates, world market demand? No, of course not. I mean, we know market rates would be a lot higher, I think, if the market actually set interest rates.
No, but it's a supply and demand of how much. It comes down to supply and demand, and so if the Fed puts a lot of money in the system, then your rates are going to drop just because you have so much money supply.
Right, but who sets the rates? The Fed essentially is setting the rates, and they're distorting the market by flooding it with liquidity. Correct?
Yeah, and they have total control over this, and it's centralized, and it's not dynamic, and it's not open source. It's central banks controlling the situation, thinking they're smarter than the markets.
Yeah.
They're not.
And that's a recipe for disaster. Anyways, eventually,
lots of inflation, lots of nastiness and booms and busts that we've seen over the decades.
Let's see. It seems someone's commenting here. It seems the high volume major stalls have been the stocks hit hardest and quickest when the market turns. PRBL looks a lot like FEYE before it got crushed. Well, let's take a look at this. Here's FEYE. Well, FEYE broke out and went straight up. So PRLB doesn't really look like that because it had a big move and then it broke down. In my view, this is a pod, probably a big double D pod here, as I like to call it. I won't get into the details of why, but it's a bit big and ugly, a big ugly double bottom, and Protolabs is reversed after trying to break out. It's hanging out, now it's under the 10-day. This is actually a pod, whereas FEYE, they don't look anything alike. This is what FEYE looked like when it broke down. So they don't look anything alike. So sorry. But PRLB looks to me like it's a pod, a double bottom type pod. So maybe something of a double pod. Look at there's an example of Cree in. Let's see if I can pull this up. How far I got to go back for this? But here is Cree trying to make a double bottom, and then it formed a little handle and it failed, and that was in 2010 and failed action in January 2011. And so PRLB has a little bit of that look to me right now. So maybe it's going to fail. It wouldn't surprise me. So I don't know what this was all about. What was this all about? Boy, somebody sure decided to sell into that. Let's see. In computing,
attempted base breakout of some sort, and so I think people saw all this money piling in. And
double bottom breakout. There it is, Dr. K, right there. But it's failed.
Yeah.
Once again, the silliness of buying breakouts. In computing the MACD 62010, do you use extended market data in the calculation? It looks like I do, because it shows up on the chart. So I guess ASCII signal. All I know is this, okay? When I was studying different intraday charts, and I started doing this after I got killed on the short side in 2009, I came up with a lot of different methods for minimizing my risk, because my observation in my own short selling up to that point was that when I make money, I can make a ton of money very fast. If I'm wrong, I can get hit pretty good. And so the trick is minimizing risk and finding better risk control methods. And so I experimented with a bunch of intraday charts and using them in context with stocks undercutting key lows or rallying up to potential areas of resistance like a moving average, like like the 200-day, 50-day, whatever, and even the 20-day exponential moving average, which I use as a point of resistance on bounces. For some reason, the stocks are going down. They don't necessarily follow the 10-day moving average, because on the downside, when stocks are moving to the upside very orderly and very rapidly, they'll hold the 10-day pretty well. But on the downside, you tend to get these sharper jacks back to the upside. Anybody who's been short knows what I'm talking about. And so the 20-day seems to be where they'll run out of gas if they're real weak. If they go past that, then generally they're going to the 50-day. But you playing with all this and studying all of this and looking at my own trades, and I came up with this chart, and I showed it to Dr. K last year, and then he took it and turned it into something more exciting, I guess. But it's worked for me, and it's very simple. And so sitting here, how do I calculate this? I don't know. I just put this chart together. I started using it, and it works. Okay. And how exactly everything is calculated, I could really give two poops about, frankly. But again, this all speaks to what level of detail do you need to make decisions in real time that can be profitable and to control your risk. You don't need a lot of detail. You don't need a lot of garbage flashing at you all day long. So it's pretty simple. I just came up with it, and as far as I know, it looks to me, if you look at the chart, that it does have some, it does move on the basis of what happens overnight, and so, yeah, I guess it's using extended trading in there. Anyways, I'm going off. I know. What would it take to move the model to a sell? Market low? I don't know. Dr. K, what would it take? Market go to break down or what?
They're kind of nonsensical because there's so many things that can happen.
Right.
It's just pointless to say. Or how close is it to a sell? Again, pointless. The signals are binary; they're on or off. Or your buy, sell, or cash. So,
right. There's no
binary.
What would it take? It would take, well, the moon would have to be in the 7th house, and Jupiter would have to be aligned with Mars, and then you would know. So as soon as you see that, sell everything.
And also, it creates a false expectation. So that if that actually does happen in your mind, then you're more likely to move to cash or to a sell signal. And that's not appropriate to actually following along the lines of what the model's guiding you to. And it's the same thing. It's like that kind of thinking can also get you out of your positions prematurely. That's why it's better to have a set of rules that you go by that should dictate your actions.
Exactly. Let's run through some questions. We're almost at the end of the hour. SWKS. So I don't know. Going sideways, holding the 20 days so far, but other than that, not too much that's exciting there. I'm not going to buy it. I'm not really interested in buying anything. The one thing, and I'll hold this out as a theory, is that I think that the top here in this correction could be was the first wave of selling, and maybe you're building a broader top there. I think there's that danger. So you never know when a correction starts. You never have any idea whether it's the start of a big new bear market or whether it's a short-term correction or not. You never know for sure, and you can't. I mean, you can surmise that the market since 2009, the market has found its footing when it's down 10%, 7-8%, but you have had corrections of more than that. I think we had one of more than 20 at one point, right, Dr. K? So so you never know what it's doing, but it seemed to me that this wave is selling in here in a lot of names, and some of the action where you're seeing them try to come back up the right side of bases and not really necessarily making it, and possibly forming pods or some other sort of pattern. Here's Netflix, all this sort of stuff, and we'll just see how it plays out. But I think there is potential for a broader top to be building, but who knows for sure. So I'm not really willing to buy stocks. So WMB, WebMed. What is this? Whoops. In here. It's a small stock. I don't know. Bible gap up fails, so this doesn't thrill me. I don't really think I want to be long stocks right now, to tell you the truth. So, FYE. What is FYE? Did you mean FEYE? Here's another one. Left shoulder, big head. It never even had a rally, though, but it's looking like a head and shoulders without the prior run-up. pretty ugly. Somebody says, I think PRLB had a buyout rumor that day. Okay. That might have been what caused that big jack to the upside. But, you know, I'll give you some sense of what might be shortable. I don't think there's anything exactly right now. I'm testing a couple of things on the short side, like I said. But, you know, the big juice was on Tuesday. And I don't know if Cinderella is going to come to the party twice in 1 week. And it is Friday, so probably the market will just utterly crash and be down 1,000 points on the Dow when I'm on a jet on Tuesday around midday, headed out to Tennessee. And that brings, I'm going to close up this webinar by just pointing out that we're going to do a webinar on Monday. We'll decide whether it's going to be during real time or Monday afternoon and do sort of a stock hunting type webinar. But since I'm going to be off the desk all week next week, won't really be able to do a webinar from where I'm at. We'll probably have just enough bandwidth to get my quotes through, but what? Somebody asked, last question, on a MACD stretch, is it the histogram or the volume that is being stretched? Well, if it's a MACD stretch, then it would be the MACD histogram. So anyways, get Dr. K to visit once the chat room. Well, maybe he'll do it while I'm gone. I don't know, but I'll probably still be on the chat room. So that, you know, that's up to him. So everybody send him an email and just harass him into doing it.
Then I won't be able to get to the questions that
Exactly,
people ask.
and it won't persuade him anyway. So you can't tell Dr. K what to do. You can beg him though. So if you all want to send him, I would say they should send you cases of wine and other things in order to ply you to come into the chat room. So meanwhile, I'm the one willing
Like a
to
drunken appearance in the chat room, huh?
yeah. Anyways, that's all we got, you guys. So it's, you know, as always, if you have any questions, you can email us, and we'll let you know when I'm on the chat room or in the chat room, on it, in it. I don't know how exactly, but that's it. That's all we got for today, and we'll catch you guys next time. So take care.
So long, everyone.